They waited until the market closed on Friday. It is an old tactic, a subtle maneuver often discussed by market analysts, occurring when traders have gone home and algorithms are running on autopilot. Last week, while most investors were focused on quarterly earnings and Federal Reserve signals, something shifted within the structure of institutional finance. A sequence of events unfolded that suggests the largest banks may have underestimated the structural forces reshaping modern markets. If you looked at the headlines over the weekend, you might have seen whispers about margin requirements, index exclusions, and closely timed institutional decisions. But the media coverage missed the deeper implication. What appeared to be routine financial maneuvering may be interpreted as a fundamental miscalculation about the physics of modern asset allocation. This discussion is for educational and analytical purposes only, and does not constitute financial advice. The story begins with MicroStrategy, a business intelligence company that transformed itself into the world's largest corporate holder of Bitcoin. With 649,870 Bitcoin worth approximately $56 billion, the company represents something unprecedented in corporate finance. Yet its market capitalization sits at just $49 billion, creating a mathematical anomaly that has attracted the attention of both institutional supporters and sophisticated short sellers. What happened last week suggests we may be witnessing the early stages of a structural collision between traditional financial engineering and the emerging physics of digital asset markets. The sequence started with margin requirements. In July, JP Chase reported changes to margin requirements for trading MicroStrategy stock from 50% to 95%. This single adjustment resulted in many traders reducing their positions, contributed to margin calls, and reduced trading liquidity. The timing appeared routine, but the magnitude was highly unusual by historical standards. 95% margin requirements represent something functionally similar to a prohibition rather than a typical trading restriction. When a major institution makes it nearly impossible to trade a stock on leverage, it sends a signal about perceived risk that extends far beyond normal market operations. Then came the index exclusion warning. JP Morgan published analysis suggesting MicroStrategy faced potential removal from the MSCI USA index, potentially triggering $2.8 billion in passive outflows, with as much as $8.8 billion at risk if other index providers followed suit. The analysis itself was dated October 10th, but it resurfaced on November 20th, coinciding with the launch of new Bitcoin exposure products by JP Morgan. The timing prompted market observers to question how product launches and market analysis can sometimes intersect during periods of elevated volatility. Over the weekend, unverified market speculation emerged suggesting JP Morgan may hold a substantial short position against MicroStrategy stock. These claims, amplified across social media platforms, suggested that a 50% rally in the stock could theoretically trigger a short squeeze scenario reminiscent of the GameStop situation in early 2021. Whether these claims prove accurate or not, their emergence coincided with a broader pattern of institutional actions that some analysts interpret as more significant than routine market positioning. We may be witnessing a phase transition in how traditional finance interacts with digital asset markets. The alignment between margin restrictions, index warnings, and product launches suggests institutional strategies are adapting to manage structural changes in asset allocation that extend far beyond normal market cycles. The technology driving this shift involves the intersection of corporate treasury management and digital asset adoption. MicroStrategy pioneered what economists call the Bitcoin treasury strategy, converting corporate cash reserves into Bitcoin holdings. This approach fundamentally altered the relationship between corporate balance sheets and monetary policy. Traditional corporations hold cash that loses purchasing power during inflationary periods. Companies adopting Bitcoin treasury strategies hold assets that are often discussed as potentially maintaining or increasing purchasing power, independent of central bank policies. The chemistry of this transformation operates through mathematical principles rather than molecular structures. When corporations convert cash flows into Bitcoin, they create exposure to monetary debasement without traditional debt instruments. The company generates cash through business operations, converts that cash into Bitcoin, and uses the Bitcoin holdings as collateral for additional capital to acquire more Bitcoin. This creates a feedback loop that amplifies exposure to Bitcoin price movements while maintaining operational business capacity. The physics of this model depends on the relationship between Bitcoin scarcity and institutional demand. Bitcoin has a fixed supply schedule, with only 21 million coins ever to exist. As more corporations adopt similar treasury strategies, they compete for a finite asset pool. Unlike traditional commodities, Bitcoin cannot be produced faster in response to increased demand. The mining schedule remains constant regardless of price or institutional interest. This fundamental supply constraint creates dynamics that traditional financial engineering is not fully designed to address. Short-selling strategies that work against traditional corporations may face different mechanics when applied to companies whose primary asset exists outside traditional banking systems. When institutions short MicroStrategy stock, they are effectively exposed to the company's operational performance and its Bitcoin holdings simultaneously. But Bitcoin trading occurs across global markets 24 hours per day, creating price discovery mechanisms that operate independently of equity market hours. The industrial scaling timeline for Bitcoin treasury adoption appears to be accelerating. Multiple corporations have announced similar strategies, from Tesla's initial Bitcoin purchase to smaller companies following MicroStrategy's model. Each adoption creates additional demand pressure on the same finite asset pool. The mathematical progression suggests that even modest adoption rates across corporate America could create supply constraints that challenge traditional market-making mechanisms. Market pricing delays occur because equity markets and Bitcoin markets operate on different timescales and through different infrastructure. Equity markets close overnight and on weekends, while Bitcoin markets continue operating. Corporate Bitcoin holdings get reflected in equity valuations through quarterly reporting cycles, while Bitcoin prices update continuously. This temporal mismatch creates arbitrage opportunities and pricing dislocations that sophisticated institutions attempt to navigate through various strategies. The implications extend beyond individual corporate strategies to systemic questions about monetary policy effectiveness and asset allocation frameworks that have governed institutional finance for decades. Current demand mathematics reveal the scale of structural changes potentially underway. MicroStrategy currently holds approximately 649,870 Bitcoin, representing roughly 3.1% of the total Bitcoin supply. The company acquired these holdings over approximately 4 years, establishing a baseline acquisition rate of roughly 162,000 Bitcoin annually. This baseline provides context for evaluating broader adoption scenarios across corporate America. Conservative adoption scenarios suggest that 50 of the largest corporations in America might adopt similar strategies over the next 5 years. If each company targets Bitcoin holdings equivalent to just 10% of their cash reserves, and if average corporate cash holdings approximate $5 billion per company, this would create demand for approximately 833,000 Bitcoin. This represents roughly 4% of total Bitcoin supply, assuming Bitcoin prices remain near current levels during the accumulation period. Moderate adoption scenarios expand this analysis to include mid-market corporations and international companies following similar strategies. If adoption includes 200 corporations globally, with average target allocations of 15% of cash reserves, demand could reach approximately 2.5 million Bitcoin. This represents nearly 12% of total Bitcoin supply, creating structural scarcity that extends far beyond normal market cycles. Aggressive adoption scenarios consider the possibility that Bitcoin treasury strategies become standard corporate finance practice, similar to how stock buyback programs became routine in the 1980s and 1990s. If institutional adoption follows historical patterns for financial innovation, demand could reach 5 to 8 million Bitcoin within a decade. This represents 25 to 40% of total Bitcoin supply being allocated to corporate treasury functions. The mathematical progression reveals why traditional financial institutions may view Bitcoin treasury adoption as a systemic risk rather than an isolated corporate strategy. If adoption follows historical patterns for financial innovation, the resulting supply constraints could fundamentally alter how monetary policy affects asset prices and corporate behavior. These demand projections assume rational, gradual adoption timelines. However, financial innovation often exhibits exponential rather than linear growth patterns. The period between initial adoption and mainstream acceptance can compress dramatically when network effects and competitive pressures accelerate institutional decision-making processes. Supply constraint analysis reveals why Bitcoin treasury strategies create fundamentally different market dynamics compared to traditional asset allocation methods. Bitcoin mining operates on a predetermined schedule that adjusts difficulty approximately every 2 weeks to maintain consistent production rates, regardless of price movements or institutional demand. This means supply cannot respond to demand increases through traditional mechanisms like increased production capacity or resource allocation. Current Bitcoin mining produces approximately 900 new coins daily, or roughly 328,500 coins annually. This production rate decreases by half approximately every 4 years through a process called halving, meaning future supply growth will slow even as institutional demand potentially accelerates. The next halving event will reduce daily production to approximately 450 coins, further constraining new supply availability. Geological limits do not apply to Bitcoin in the traditional sense, but mathematical limits create similar constraints. The total supply of 21 million coins represents an absolute ceiling that cannot be exceeded regardless of demand pressure or price levels. Unlike commodities where higher prices can make previously uneconomical deposits viable, Bitcoin's supply schedule remains fixed independent of market conditions. Recycling realities in Bitcoin markets operate differently than traditional commodity markets. Bitcoin holders can sell their holdings back to markets, but institutional buyers adopting treasury strategies typically hold for long periods rather than trading actively. MicroStrategy has never sold Bitcoin from its treasury holdings, establishing a precedent for permanent allocation rather than cyclical positioning. If other corporations adopt similar hold-forever strategies, Bitcoin allocated to corporate treasuries effectively exits the tradable supply pool permanently. Political and geographic factors create additional supply constraints that traditional analysis often underestimates. Bitcoin mining concentrates in regions with cheap electricity and favorable regulatory environments. Changes in energy policy, environmental regulations, or cryptocurrency legal frameworks in major mining regions can affect supply availability independent of demand conditions. China's mining ban in 2021 demonstrated how quickly geopolitical decisions can disrupt supply chains that appear stable. Historical commodity transitions provide context for understanding how new demand sources interact with constrained supply. The palladium market in the early 2000s offers instructive parallels. When automotive manufacturers switched to palladium for catalytic converters, industrial demand overwhelmed existing supply chains. Palladium prices increased from approximately $200 per ounce to over $1,000 per ounce within 2 years, as supply could not respond quickly enough to demand increases. The rare earth metals crisis of 2010 demonstrates similar dynamics. When China restricted rare earth exports, manufacturers dependent on these materials faced immediate supply shortages despite having functioned normally for decades. Prices for some rare earth elements increased by 500 to 1,000% within months, as industrial users competed for limited available supply. These historical examples illustrate how supply constraints interact with institutional demand to create price dynamics that overwhelm traditional forecasting models and risk management frameworks developed for more elastic markets. Bitcoin treasury strategies create network effects that amplify beyond individual corporate decisions. When MicroStrategy announced its initial Bitcoin purchase, the action appeared isolated to a single company's capital allocation strategy. However, network effects in corporate finance tend to follow exponential rather than linear progression curves. Each additional corporation adopting similar strategies validates the approach for competitors and peers, reducing perceived implementation risk and accelerating adoption timelines. The mathematics of network adoption in corporate finance follow established patterns observed in technology adoption, supply chain integration, and financial innovation cycles. Initial adoption typically involves risk-tolerant early movers willing to accept implementation costs and regulatory uncertainty. These pioneers establish operational frameworks, legal precedents, and best practices that reduce barriers for subsequent adopters. Second-wave adoption occurs when competitive pressures force industry participants to evaluate similar strategies to maintain market positioning. Companies that initially viewed Bitcoin treasury strategies as speculative begin reconsidering when competitors demonstrate operational success and financial benefits. This competitive dynamic can compress adoption timelines from years to quarters as market forces accelerate decision-making processes. Third-wave adoption represents mainstream acceptance, where Bitcoin treasury strategies become standard corporate finance practice rather than innovative positioning. Historical parallels include stock buyback programs in the 1980s, derivatives usage in the 1990s, and offshore cash management strategies in the 2000s. Each innovation followed similar adoption curves, transitioning from experimental to essential over periods of 5 to 10 years. The current trajectory suggests Bitcoin treasury adoption may be entering the second wave, where competitive pressures begin influencing corporate decisions independent of individual company risk tolerance or Bitcoin price movements. Tesla's Bitcoin purchase, followed by similar announcements from smaller corporations, indicates network effects may be accelerating beyond the pioneer phase established by MicroStrategy. Corporate treasury departments typically manage cash allocation through established frameworks designed for traditional assets. Cash reserves earn minimal returns but provide operational flexibility and financial stability. Government bonds offer higher returns but expose corporations to interest rate and inflation risks. Corporate bonds provide additional yield but introduce credit risk and liquidity constraints. Bitcoin treasury strategies introduce a fundamentally different risk-return profile that challenges traditional corporate finance frameworks. Bitcoin provides potential inflation hedge characteristics while introducing volatility that exceeds traditional treasury assets. However, the mathematical properties of Bitcoin scarcity create asymmetric risk profiles that may justify allocation percentages that appear excessive under traditional risk management models. The asymmetric risk profile emerges from Bitcoin's fixed supply schedule interacting with institutional demand growth. Downside risk remains bounded by Bitcoin's value approaching zero, while upside potential scales with network adoption and monetary debasement. Traditional corporate assets typically exhibit symmetric risk profiles where potential losses approximate potential gains over extended periods. This mathematical asymmetry suggests optimal allocation percentages for Bitcoin treasury strategies may exceed traditional diversification guidelines. Modern portfolio theory typically recommends limiting individual asset exposures to prevent concentration risk. However, assets with genuinely asymmetric risk profiles may justify higher allocation percentages when mathematical modeling accounts for supply constraints and network effects. The operational mechanics of Bitcoin treasury implementation require infrastructure development that creates switching costs for participating corporations. Companies must establish cryptocurrency custody solutions, accounting frameworks, regulatory compliance procedures, and board governance structures. These implementation costs create barriers to entry, but also barriers to exit once systems are operational. Switching costs in corporate finance typically reinforce network effects by making strategy reversals expensive and operationally complex. Companies that invest in Bitcoin treasury infrastructure face significant costs to unwind these systems, creating persistence in adoption even during periods of Bitcoin price volatility. This operational momentum contributes to network stability and reduces the likelihood of mass corporate Bitcoin sales during market downturns. The accounting implications of Bitcoin treasury strategies create additional momentum effects through financial reporting requirements. Generally accepted accounting principles require corporations to mark Bitcoin holdings to market value quarterly, creating earnings volatility that reflects Bitcoin price movements. However, this accounting treatment also means Bitcoin price increases flow directly to corporate earnings, creating shareholder pressure to maintain and expand Bitcoin allocations during favorable periods. The regulatory landscape surrounding corporate Bitcoin adoption continues evolving as government agencies adapt oversight frameworks to address digital asset treasury strategies. The Securities and Exchange Commission has issued guidance on cryptocurrency accounting and disclosure requirements. The Financial Accounting Standards Board continues evaluating whether current accounting standards adequately address digital asset holdings by corporations. Regulatory clarity typically reduces implementation barriers and accelerates adoption by removing uncertainty that inhibits corporate decision-making. As regulatory frameworks solidify, corporations that previously avoided Bitcoin treasury strategies due to compliance concerns may reconsider these approaches. This regulatory progression could accelerate network effects beyond current mathematical models based on purely economic factors. The international dimension of Bitcoin treasury adoption creates additional complexity as corporations navigate different regulatory frameworks across jurisdictions. Companies with global operations must consider how Bitcoin holdings affect tax obligations, regulatory compliance, and financial reporting in multiple countries. These complexities initially slow adoption but create competitive advantages for early movers who develop operational expertise. International tax treatment of corporate Bitcoin holdings varies significantly across jurisdictions, creating opportunities for tax optimization that may accelerate adoption among multinational corporations. Countries competing for corporate headquarters and treasury operations may adjust cryptocurrency taxation policies to attract companies adopting Bitcoin treasury strategies. The macroeconomic environment continues influencing corporate evaluation of Bitcoin treasury strategies through monetary policy decisions that affect traditional asset returns and currency stability. Central bank policies that maintain low interest rates reduce returns available from traditional corporate treasury investments, making Bitcoin's potential returns more attractive despite volatility concerns. Inflation expectations play a crucial role in corporate treasury decision-making as companies evaluate assets that may preserve purchasing power during periods of monetary expansion. Traditional corporate treasury assets typically lose real value during inflationary periods, while Bitcoin's fixed supply schedule provides theoretical protection against currency debasement. The correlation between Bitcoin returns and traditional assets remains a critical factor in corporate risk management evaluation. Historical data suggests Bitcoin correlations with stocks and bonds vary significantly over time, sometimes providing diversification benefits and sometimes amplifying portfolio risk. Corporate treasury departments must model these correlation dynamics when determining appropriate Bitcoin allocation percentages. Liquidity considerations affect corporate Bitcoin treasury strategies through the need to maintain operational cash flows while maximizing treasury returns. Bitcoin markets provide significant liquidity for smaller transactions but may face capacity constraints if large corporations simultaneously attempt to liquidate substantial positions. This liquidity asymmetry creates timing advantages for early adopters who can accumulate positions during periods of abundant market liquidity. The custody and security requirements for corporate Bitcoin holdings represent operational challenges that require specialized infrastructure and expertise. Traditional corporate treasury departments typically lack cryptocurrency security protocols, creating implementation barriers that slow adoption. However, the development of institutional custody solutions and insurance products continues reducing these operational barriers. Corporate governance frameworks require adaptation to accommodate Bitcoin treasury strategies as board oversight responsibilities expand to include cryptocurrency risk management and strategic allocation decisions. Directors without cryptocurrency expertise face challenges evaluating management proposals for Bitcoin treasury implementation, potentially slowing corporate decision-making processes. Shareholder communication strategies become increasingly important as corporations adopting Bitcoin treasury approaches must educate investors about cryptocurrency risk profiles and strategic rationales. Companies like MicroStrategy have demonstrated that clear communication about Bitcoin strategies can attract investors specifically interested in cryptocurrency exposure through traditional equity markets. The structural changes examined here suggest we have crossed a threshold where mathematical constraints increasingly govern financial outcomes, independent of institutional preferences or regulatory intentions. Corporate Bitcoin treasury adoption appears to be transitioning from experimental positioning to operational necessity as traditional monetary policy mechanisms lose effectiveness in preserving corporate purchasing power. The sequence of events surrounding JP Morgan's margin requirements, index exclusion warnings, and alleged positioning illustrates how established financial institutions respond when confronted with asset allocation strategies that operate outside conventional risk management frameworks. The mathematical properties of Bitcoin scarcity create dynamics that traditional financial engineering struggles to address through normal market-making mechanisms. What emerged over the past week indicates that physical constraints may be imposing limits on financial positioning strategies that previously functioned effectively in markets with elastic supply responses. The coordination between margin restrictions, product launches, and market pressure campaigns suggests institutional adaptation to structural changes that extend far beyond normal market cycles. The corporate treasury revolution initiated by MicroStrategy has already influenced real-world allocation decisions across dozens of companies, even as equity market pricing continues reflecting traditional valuation methodologies. This disconnect between operational reality and market pricing creates conditions where structural forces may overwhelm conventional financial positioning, regardless of institutional intent or market manipulation capabilities. Subscribe to stay informed about structural changes reshaping modern markets.